Mining is more than an industry. It's a mirror of our global ambition to build, to innovate, to transition toward a cleaner, electrified future. And yet beneath that ambition lies the one constant that defines whether a company survives or whether they collapse, and that's risk. Risk is the heartbeat of mining. We all know that. It is what drives strategy, investment, and every decision made hundreds of meters below the surface and thousands of kilometers away in boardrooms. Yet for an industry that operates on precision, too often risk management has been treated as an afterthought, something to review once the damage is already done. Today, that mindset is no longer sustainable. The mining world of 2025 and beyond is one where climate, conflict, and capital are colliding. Natural disasters, they're not seasonal events anymore, they're operational threats. And community opposition is not a public relations issue. It's a cost of capital issue. And cyber risk is not confined to financial firms. It's hitting processing plants and infrastructure at accelerating rates. Just look at recent history. When severe flooding hit coal operations in Australia's Hunter Valley last year, insured losses topped hundreds of millions and production delays rippled across global energy markets. In South America, new resource tax legislation and political shifts have triggered investor fight and contract disputes, exposing how fragile geopolitical stability can be. Now, closer to home, ransomware attacks on major mining networks have frozen operations and forced emergency shutdowns. This is proof that digital risk is now as material as physical risk. This is why proper, fully integrated risk management and insurance are not optional. It's foundational. The companies that understand this are building resilience before crisis even strikes. They're using advanced analytics to model risk exposure. They're transferring catastrophic loss through specialized insurance structures, and they're ensuring their coverage keeps pace with the complexity of their operations. Because the reality is, insurance isn't just a safeguard, it's a signal. You are actually showing investors, lenders, and communities that your company understands exposure, it understands the value and the transparency, and has planned for volatility. In a market where uncertainty defines value, risk management is value. Take the example of a copper miner in Peru that combined environmental liability coverage with political risk insurance. When protests shut down access routes for nearly a month, operations were obviously disrupted. But insured continuity allowed production to recover quickly and capital partners to stay on board. This is the kind of strategic foresight that turns risk into advantage. As insurers tighten underwriting standards and political landscapes shift across critical resource regions, the miners who can clearly demonstrate the risk profile and prove they have mitigated it are the ones who continue to attract the capital. Everyone else will get left behind. The mining companies that thrive in this new era are those that view insurance not as a cost, but as a strategic partner, one that allows operations to continue after catastrophe, stabilizing earnings after disruption, and supports long-term investor confidence. And that's really the point here that often is missed. Risk management is not about avoiding loss, it's about ensuring continuity. It's about keeping the lights on when the market flickers. And in an age defined by climate volatility, geopolitical uncertainty, and global financial recalibration, mining without comprehensive risk protection, that's not bold, that's reckless. So the question becomes this: in a world where risk is the one constant, are you managing it, or is it managing you? I'm Lyndsay Malchuk with Avoidance Media, and this is your Market Knowledge.